Silver is the new gold. That's not just a flashy YouTube title or a clickbait phrase I threw together in 5 minutes. It's the conclusion of several months of deep research, late-night reading, charts, reports, and a lot of questioning my own assumptions. And in this video series, I want to take you step by step through that journey and show you why I believe silver is one of the most misunderstood assets on the planet right now. But before we get into any of that, let me be very clear about one thing. What you're about to hear is my personal understanding and research. It is not financial or investment advice. I am not your financial advisor. I am not telling you to buy anything, sell anything, or change your portfolio. Whatever you choose to do or not do with this information is completely your responsibility. Use this video as education and as a starting point for your own research, not as a signal to press the buy or sell button. Now, with that out of the way, let's zoom out and look at silver from a very long-term perspective. When most people think about precious metals, the first word that comes to mind is gold. Gold has the reputation, the history, the cultural weight. It's in our stories, our jewelry, our central bank reserves. But silver has been standing right next to gold for thousands of years. In fact, for a huge part of human history, silver was money just as much as gold was, and in many places, even more so. Think about how strange our modern view is. Today we think of silver mostly as jewelry, coins, maybe some religious items, or a gift you give someone at a wedding. But if you go back in time, silver was not primarily something you kept or decorated yourself with. Silver was what you used. It was the medium of exchange. It was how people paid taxes, settled debts, bought land, and measured wealth. When someone said money hundreds of years ago, they were often talking about actual pieces of silver or gold, not paper with ink on it. Coins weren't just symbols. They were the thing itself. The metal was the value. So what changed? Over the last century or so, governments around the world moved away from metal-backed money and toward what we call fiat currencies. Paper money that has value because the government says it does and because we all agree to use it. This transition didn't happen overnight, but step by step, gold and silver were pushed out of the everyday monetary system. First, paper notes were introduced as convenient claims on gold or silver. Then slowly, those claims were removed. Convertibility was limited, then canceled. Gold backing was reduced, then scrapped. And eventually, we reached a world where dollars, euros, rupees, and other currencies are no longer tied to physical metal at all. They're backed by trust, laws, and the productive capacity of the countries that issue them. In that process, silver quietly lost its official role as money. It didn't lose its properties. It still remained durable, divisible, and relatively scarce.
But it stopped being part of the formal definition of money in most economies. It was pushed into a corner, part jewelry, part investment, part industrial raw material. Now here's where things get interesting. If you look at history over a very long time, we're talking centuries, not years, you see that gold and silver had a fairly stable relationship with each other. This relationship is often expressed as the gold-to-silver ratio. That is just a fancy way of asking, how many units of silver does it take to equal 1 unit of gold? Historically, that ratio tended to sit somewhere roughly between 10 and 20. That means 1 unit of gold, say 1 gram, would often trade for 10 to 20 grams of silver. Markets moved, prices changed, but they tended to oscillate around that range for long stretches of history. In other words, gold was more valuable than silver, but not insanely more valuable. Fast forward to the modern fiat era, where gold and silver are no longer used as everyday currency. The relationship between them starts to look very different. Once governments stopped using them as money, they became more like assets or commodities that trade in financial markets. Speculation, derivatives, ETFs, and central bank policies all began to influence their prices in new ways. The result? That long-term gold-to-silver ratio started to stretch. Instead of 10 or 15 or 20, we began to see 40, 50, 60. And recently, in late 2025, that ratio has been hovering around 80. That means you need about 80 grams of silver to match the price of just 1 gram of gold. Just pause on that number for a second. Historically, 1 gram of gold, 10 to 20 grams of silver. Today, 1 gram of gold, 80 grams of silver. Something clearly changed. The question is, what? When you see a gap this big, there are a few ways to interpret it.
Option 1. Maybe gold is wildly overvalued. Maybe people are irrationally pouring into gold, pushing its price up far beyond its real worth. Option 2. Maybe silver is being massively undervalued, or maybe its demand is weak and the market just doesn't care about it the way it used to. At first glance, both of those explanations sound possible. But as we'll see in the next chapters, neither one really matches the full picture. To understand why, we need to think about value in a different way. Gold doesn't really change. An ounce of gold 100 years ago is chemically the same as an ounce of gold today. What changes is the currency we measure it in. Because of inflation, the slow erosion of purchasing power, fiat currencies lose value over time. When that happens, the price of gold in that currency tends to go up. It's not that gold suddenly became magical. It's that the measuring stick, the currency, got weaker. So when we say, gold is at an all-time high, what we often really mean is, our currency has fallen to an all-time low against gold. That's a very different way of looking at it. If gold is mostly a mirror showing us the weakness of money, then calling it overvalued doesn't make much sense. Gold doesn't grow earnings or launch new products. It just sits there and reflects the health of the monetary system. That brings us back to silver. If gold isn't really overvalued in the traditional sense, what explains the massive gap between gold and silver today? Why does the market say that gold is worth roughly 80 times more than silver, when historically the ratio was much lower, and when the above-ground supply ratio is only around 10 to 1? This is where the story of silver gets really interesting, and where silver is the new gold starts to make sense. Because silver is no longer just a monetary metal sitting next to gold. It is also a critical industrial metal embedded in the technologies that define our future. In the next chapters, we're going to dig into how the gold-to-silver ratio became so distorted, why silver has quietly slipped into a structural deficit, how electric vehicles, solar panels, electronics, and AI data centers are all eating up more and more silver every year, and why increasing silver supply is much harder than most people think. For now, all you need to remember from this first chapter is this. Silver has a long history as real money right alongside gold. The relationship between gold and silver has never been as stretched as it is today in the modern era. And that gap is not just a random glitch. It is a signal that something very big is happening beneath the surface. This video is not here to tell you what to buy. It's here to help you see what most people are not even looking at. Silver has a long history as real money right next to gold, and today the relationship between the two looks more stretched than ever. Now it has time to zoom in on one of the most important numbers in this entire story, the gold-silver ratio. If you've never heard of this ratio before, don't worry. It sounds technical, but the idea is actually very simple. The gold-silver ratio tells you how many units of silver it takes to equal 1 unit of gold in price. That's it. It's just a way of comparing the relative value of the two metals. For example, if the ratio is 10, that means 1 ounce or 1 gram of gold costs as much as 10 ounces or 10 grams of silver. If the ratio is 20, gold is 20 times more expensive than silver. If the ratio is 80, gold is 80 times more expensive than silver. Now, here's where things start to get strange. For long stretches of history, this ratio tended to live in a fairly tight band, somewhere between about 10 and 20. Markets were not perfectly efficient, and there were periods where the ratio moved higher or lower, but over time it kept gravitating back toward that zone. In other words, the world seemed comfortable with the idea that gold should be roughly 10 to 20 times more valuable than silver. That makes some intuitive sense. Gold is rarer. Gold is often hoarded and stored as wealth. Silver is more abundant and has more industrial uses. Gold is the king. Silver is the right-hand man. But remember what we talked about earlier. The world changed. We moved from a metal-backed monetary system to a world of fiat currencies. Gold and silver stopped circulating as everyday money and started trading more like financial assets or commodities. Central banks accumulated gold. Investors traded futures and options. ETFs were created. Speculation increased. In this new environment, the gold-silver ratio began to drift away from its old historical norms. Instead of 10 to 20, we started seeing 30, then 40, then 50. In recent decades, it wasn't unusual to see the ratio around 60. And now, in late 2025, it is hovering in the neighborhood of 80. 1 unit of gold costs about 80 units of silver. So what does that actually mean in practice? Put simply, if you wanted to trade 1 gram of gold for silver at today's prices, you'd get around 80 grams of silver in return, or 1 ounce of gold would get you about 80 ounces of silver. Now ask yourself a very basic question. Does that make sense? If gold is truly worth 80 times more than silver, you'd expect the world to have 80 times more silver available than gold. But that's not what we see. Estimates of above-ground stocks suggest that the total amount of silver available is maybe around 10 times more than gold, not 80 times. That's not a precise fixed number, but it gives us an order of magnitude. So we have a strange situation. The price ratio is around 80 to 1. The supply ratio is closer to 10 to 1. The question practically screams at us. Why is the price ratio so much higher than the supply ratio? There are a few possible explanations, and each one has different implications. Explanation 1. Gold is extremely overvalued. Maybe investors have bid up gold to irrational levels, far beyond any reasonable relationship to reality. If that's true, then the ratio looks crazy because gold is in a bubble. Explanation 2. Silver is deeply undervalued or ignored. Maybe silver has been left behind, forgotten by mainstream investors, and heavily influenced by short-term speculation or even structural issues in the market. Explanation 3. Some combination of both. Maybe gold is a bit rich, silver is a bit cheap, and the ratio is stretched from both sides. Before we jump to conclusions, we need to think carefully about what value even means when we talk about gold. Gold is not a company that earns profits. It's not a technology that becomes obsolete. It doesn't pay dividends. It just exists. In many ways, gold is a mirror for the monetary system. When people lose confidence in currencies, they run toward gold. When inflation erodes the purchasing power of money, gold prices in that currency tend to rise. But does that mean gold suddenly became more valuable? Or does it mean that the measuring stick, the currency, got weaker? Think about it this way. If you have a ruler that keeps shrinking, everything you measure with it will look longer, even if nothing actually changed. That's what inflation does to money. As fiat currencies are printed and their purchasing power goes down, it looks like gold is going up. But often, gold is just standing still while everything else sinks. So when someone says, gold is at an all-time high, the more honest way to phrase it might be, our currency is at an all-time low against gold. That's a very different perspective. Now, if gold's main job is to reflect the weakness of fiat money, then calling gold overvalued becomes tricky. Overvalued compared to what? Compared to a currency that is constantly being devalued. Compared to stocks, bonds, or real estate that are also influenced by central bank policies and debt cycles. This doesn't mean gold can never be overpriced on a short-term basis. Markets can overshoot in both directions, but it does suggest that the massive gold-silver ratio probably isn't right just about gold being too expensive. That brings us back to silver. If gold is not dramatically overvalued and is mostly doing its job as a monetary metal, then the extreme ratio we see today starts to look more like a silver problem than a gold problem. Maybe silver is not being priced according to its rarity, its history, and, as we'll explore, its growing industrial importance. Here's another way to think about this. Imagine 2 runners in a race. For most of the race, they stay within a few meters of each other. Sometimes one pulls ahead, sometimes the other, but they never get too far apart. Then suddenly, in the last lap, one runner is 80 meters ahead, while the other is only 10 meters behind compared to where they used to be. You'd immediately ask, what happened? Did someone trip? Did someone get injured? Did something outside the race interfere? That's exactly the kind of question we should be asking about gold and silver. For centuries, they moved more or less together, with gold leading but silver following at a reasonable distance. Now, in the modern financial era, gold has run so far ahead in price terms that the ratio has blown out to levels that look completely disconnected from historical patterns and from basic supply comparisons. Of course, markets don't owe us fairness. Just because something looks historically stretched doesn't mean it has to snap back tomorrow. The gold-silver ratio could stay high for years. It could even go higher in a panic or a deflationary shock. Markets can be irrational for much longer than we expect. But when you combine this stretched ratio with what we'll see in the next chapter, a persistent structural deficit in silver and booming industrial demand, the case for silver being mispriced becomes a lot more compelling. To summarize this chapter, here are the key points you should keep in mind. The gold-silver ratio is a simple way of comparing their relative prices. For long periods of history, that ratio hovered around 10 to 20. In the modern fiat era, the ratio has stretched dramatically and now sits around 80. The above-ground supply ratio of silver to gold is closer to 10 to 1, not 80 to 1. This creates a huge disconnect between relative price and relative supply. It's hard to explain this entirely by saying gold is too expensive, especially when gold's role is to reflect the weakness of fiat currencies. That pushes us toward a different conclusion. Silver may be significantly underpriced relative to its history, its supply, and its real-world uses. In the next chapter, we're going to connect this price distortion to something very concrete and measurable: demand and supply. We'll look at how silver has quietly slipped into a multi-year structural deficit, how industries like electric vehicles, solar energy, electronics, and AI infrastructure are consuming more and more silver every year, and why the market has been slow to price that in. We focused on the gold-silver ratio and how the price relationship between these two metals has drifted far away from historical norms. We saw that gold is trading at roughly 80 times the price of silver, even though above-ground silver stocks are nowhere near 80 times larger than gold. That disconnect raised a big question. Is silver being mispriced by the market? To answer that, we need to look at something very real and very measurable: demand and supply. Not charts on a screen. Not just financial speculation. Actual physical silver moving through the real economy. And when you start looking at those numbers, a very clear pattern shows up. Silver is no longer just a precious metal that sits in vaults. It has quietly become one of the most important industrial metals of our time. Let's start with one key concept: structural deficit. A structural deficit simply means that, year after year, demand for a commodity is greater than its supply. Not just in one freak year, not because of a temporary shock, but as an ongoing pattern. For silver, that's exactly what has been happening recently. According to multiple market analyses and surveys, the silver market has recorded repeated annual deficits since around 2021, with demand consistently exceeding mine production plus recycling. Above-ground inventories have been drawn down to fill the gap. That alone is significant. But what really matters is where this demand is coming from. And this is where silver's story breaks away from gold. Gold demand is heavily concentrated in jewelry, investment, and central bank reserves. Silver used to be more similar. Today, that's no longer the case. Industrial applications have taken over. In 2024, industrial uses consumed on the order of 50–60% of total global silver demand, roughly 680 million ounces in 1 year, according to recent industry estimates. In other words, more than half of all the silver the world uses now goes into technology and industry, not coins and necklaces. So what changed? 3 huge megatrends all started colliding at the same time: the transition to electric vehicles, the global solar energy build-out, and the explosion of electronics, data centers, and AI infrastructure. Let's take them one by one. First, electric vehicles. An average internal combustion engine car uses some silver, but not a lot. It's present in switches, electronics, and contacts, but the overall load is modest. Electric vehicles, on the other hand, are a completely different story. They rely on complex power electronics, battery management systems, high current connections, charging ports, and much denser wiring. All of that needs reliable, highly conductive materials, and silver is the best electrical conductor of all metals. Recent estimates suggest that a typical battery electric vehicle uses roughly 25 to 50 grams of silver, significantly more than a traditional combustion car, with EVs consuming on average 67 and 79% more silver than internal combustion vehicles. Now multiply that by millions of EVs produced every year, and then by the growth rate of EV adoption. One report highlighted that EVs already make up more than 1/5 of global light vehicle production, and are expected to keep growing at double-digit rates for years. And it isn't just the vehicles themselves. The charging infrastructure, fast chargers, power electronics, grid connections, also uses silver-bearing components. So with every new EV on the road, there is an echo of additional silver use in the system that supports it. Next, solar energy. Solar panels have become one of the biggest single sources of silver demand in the world. Silver is used in photovoltaic cells as a conductive paste for the front and back contacts that carry the electrical current generated by sunlight. Over the last decade, the share of silver demand coming from photovoltaics has surged. One analysis shows that solar now accounts for close to 30% of total industrial silver consumption, up from just around 10% a decade ago. That growth isn't slowing down. As countries push toward net zero targets and try to decarbonize their power grids, solar capacity is being installed at record rates. Forecasts suggest that solar-related silver demand could nearly double between 2020 and 2030, and that cumulative demand from solar alone through 2050 could equal a huge percentage of today's known silver reserves. Every new panel on a roof or in a utility-scale solar farm quietly pulls a little more silver out of the market. Now add the third megatrend: electronics, data centers, and AI. We already live in an electronics-saturated world. Smartphones, laptops, routers, 5G networks, smart home devices, industrial sensors, medical equipment, all of these use silver in connectors, switches, antennas, and circuit boards because of its unmatched conductivity and reliability. But the AI wave is turning that demand up another notch. Artificial intelligence workloads require massive data centers packed with high-performance servers, GPUs, and power systems. These data centers need extremely efficient electrical pathways, thermal management, and power conditioning. Silver is being used in high-efficiency contacts, specialized components, and advanced cooling systems. At the same time, AI's appetite for electricity is forcing utilities and governments to build even more renewable energy capacity, especially solar, which loops us back to that second megatrend. On top of that, there are more niche but growing uses. Silver coatings are utilized in advanced medical devices for their antimicrobial properties. 5G and future communication networks rely on silver-based components in some antennas and RF modules. The expansion of the Internet of Things adds millions of new connected devices, each with tiny amounts of silver inside. On their own, these may look small, but together they create a steadily rising base of industrial demand. So here is the picture that starts to emerge. Industrial applications now dominate silver demand, accounting for more than half of total usage and trending higher. Key sectors like EVs, solar, and AI data centers are all expected to grow strongly over the next decade. Many of these uses are mission-critical. You can easily swap silver out without sacrificing performance or reliability. At the same time, the supply side is not nearly as flexible. Unlike gold, where a large part of supply is driven by primary gold mines, a significant portion of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. That means you can just flip a switch and double silver production, because silver is often tied to the economics of other metals. If copper demand isn't booming, you don't get a big jump in byproduct silver, no matter how high silver demand goes. Recycling helps, but it's not a magic solution. A lot of silver used in electronics and industrial applications is dispersed in tiny amounts, in pastes, solders, thin films, and microcomponents. Recovering that silver is technically difficult and often not economical at current price levels. As a result, a meaningful portion of silver that goes into high-tech applications is effectively lost for a long time. It ends up in landfills or in products that won't be recycled for decades. Put all of this together and you get exactly what we're seeing: repeated annual deficits, where total demand outstrips total supply year after year, and above-ground inventories are quietly drawn down to fill the gap. This is not just a short-term spike or a one-off event. It's a structural shift in how the world uses silver. And remember the key point from the last chapter. While this is happening in the real economy, the financial markets are still pricing silver as if it were just another sleepy precious metal sitting in the shadow of gold with a gold-silver ratio around 80. That's the heart of the opportunity and the risk. On one hand, if these trends continue, EV adoption, solar expansion, AI build-out, and broader electrification, then industrial demand for silver is likely to stay strong or even accelerate over the next decade. On the other hand, increasing supply meaningfully is slow, capital-intensive, and heavily dependent on the economics of other base metals. Does that guarantee that silver prices will explode? No. Markets do not move in straight lines. Prices can stay depressed or volatile for long periods, even when fundamentals look strong. But from a structural point of view, the setup is very unusual. A critical industrial metal with growing demand, constrained supply, and a price that still treats it as a second-class cousin of gold. In the next chapter, we'll look at what this all means from an investment and risk perspective. We'll dig deeper into how silver mining actually works, what role investment vehicles like silver ETFs play, and why, Even with all these bullish factors, predicting the short-term price of silver is still almost impossible. For now, you should walk away from this chapter with one core idea. Silver is no longer just a shiny metal in coins and jewelry. It's embedded in the infrastructure of the future, in our cars, our energy systems, our communication networks, and the data centers that power AI. And the world is using more of it than we're producing. Now, in this final chapter, we need to talk about what all of this actually means, and what it doesn't mean. Because the last thing you should take from this series is a simple, reckless message like silver only goes up. That's not how reality works. Let's start with the supply side, because that's where a lot of people misunderstand how constrained silver really is. Unlike many other commodities, silver is not mostly produced from giant pure silver mines. A meaningful share of global silver production comes as a byproduct of mining other base metals like copper, lead, and zinc. That means silver output is often tied to the economics of those other metals. If copper prices are weak and copper mines aren't expanding, you don't suddenly get a big surge in byproduct silver just because silver demand is hot. There are primary silver mines, of course, but bringing new mines online is not a quick or simple process. It involves exploration, permitting, environmental approvals, financing, infrastructure, and years of construction. It can easily take a decade or more from discovery to full production. That timeline doesn't care about the latest trend in EV sales or AI hype. Recycling sounds like a natural solution, and it does help, but it's also limited. A lot of silver used in modern technology is spread out in very small amounts, in solder, pastes, coatings, connectors, and microcomponents embedded across millions of devices. Technically, you can recover some of it, but the process is complex and often not economical at current price levels. As a result, much of the silver used in electronics and industrial products ends up sitting in landfills or in long-life equipment that to be recycled for decades. So you have a commodity where demand is being driven by long-term global megatrends, electrification, decarbonization, digitalization, but supply is slow, constrained, and partially dependent on other metals. That's the engine behind the repeated structural deficits we talked about. From a macro point of view, that setup looks extremely bullish. And that's exactly why so many analysts and commentators say things like, silver is the most undervalued asset in the market, or silver is the trade of the decade. But here's where we need to be very careful. Just because the fundamentals look strong doesn't mean the price will move in a straight line or on your preferred timeline. Markets are not equations. They are crowds of humans and algorithms, full of fear, greed, leverage, and short-term noise. Silver, in particular, has a reputation for being volatile. The same leverage that can send prices sharply higher when momentum is positive can also magnify moves to the downside when sentiment flips. Margin calls, forced liquidations, and speculative positioning can all create violent short-term swings that have very little to do with underlying supply and demand. On top of that, the modern silver market isn't just about physical bars and coins. It also includes futures contracts, options, and exchange-traded funds, ETFs, that track silver prices or hold physical silver on behalf of investors. These financial instruments make it easier for large pools of capital to move in and out of silver exposure very quickly. When flows are positive, they can amplify rallies. When flows turn negative, they can accelerate drops. So even if you are completely convinced that silver is undervalued relative to gold, relative to its industrial importance, and relative to its historical role, you still face two massive uncertainties: timing and volatility. Timing is unknowable. The market can stay irrational much longer than any individual investor can stay patient or solvent. Silver could grind sideways, spike, crash, or chop around for years before any big repricing happens. Structural deficits can exist for a long time before the price finally reflects them. Volatility is unavoidable. If you look at silver's price history, you see sharp booms followed by deep corrections. Anyone who bought at the top of a spike and panicked at the bottom of a correction knows how painful that ride can be. This brings us to the most important part of this closing chapter. This is not a call to action. It is a call to understanding. The goal of this series is not to convince you to load up on silver, mortgage your house, or chase quick riches. The goal is to give you a deeper, more nuanced view of what silver actually is in today's West world. A metal with a monetary past and a technological future, caught between financial markets that still treat it like a side character and industrial realities that increasingly rely on it. If you decide that silver deserves a place somewhere in your overall strategy, that decision should come after you. Review your own financial situation, understand your risk tolerance, consider your time horizon, and learn about the different ways to get exposure: physical metal, mining stocks, ETFs, or other vehicles, each with their own pros and cons. And before you put a single dollar at risk, you should also understand that none of what you heard here guarantees any particular outcome. Prices can go up, down, or nowhere for years. There can be policy changes, technological breakthroughs that reduce silver use in some applications, new discoveries that increase supply, or economic shocks that crush demand temporarily. So here is the clear, honest bottom line. Silver has a powerful long-term story: tight supply, growing industrial demand, and a historically stretched relationship to gold. That story might translate into higher prices over time, but there are no promises, no shortcuts, and no guarantees. Treat this as one piece of a larger puzzle, not as a magic solution. If you're serious about this topic, your next step should not be to open a trading app. Your next step should be to open more sources. Read independent research. Look at reports from industry groups. Study how silver fits into your broader financial and life goals. And if you're considering meaningful investments, talk to a qualified financial advisor who understands commodities and can look at your personal situation. As we wrap up this documentary, remember the core idea we started with. Silver is the new gold. Not because gold has stopped mattering, but because silver has stepped into a new role. It is money from the past and metal for the future, woven into the wiring of our energy systems, the circuits of our devices, and the engines of the digital economy. Whether you choose to act on this information or not, at least now you're not looking at silver as just another shiny metal. You're seeing the bigger picture. And sometimes understanding that bigger picture is the most valuable asset you can own. This was my research, my perspective, and my attempt to connect the dots for you. It is not investment advice. Do your own research, make your own decisions, and take full responsibility for the choices you make. Thank you so much for watching and for staying with me till the end.